Good afternoon to all, and welcome to another round of discussion on EPS COVID Special Value Online Show. We have this show, as you know, every day at this time to discuss subjects of interest in the financial world. Today, we have no less a subject matter expert than Mr. Jaspal Bindra to talk to us on the theme of challenges and opportunities in NBFC, non-banking financial companies. This talk is live on UPS platform, YouTube, and Twitter. We have been getting tremendous response, and we feel humbled and thankful to all the participants for joining us in this platform to express solidarity against COVID. We also take this opportunity to express our sincere gratitude to the COVID warriors who are leading the fight to secure us, our lives, and country. Welcome, Mr. Bindra. Mr. Bindra has years, thank you, sir. Mr. Bindra has years of experience in banking. He was the CEO of one of the large global bank, namely Standard Chartered Bank, we all commonly known as StanChart. He has also worked with Bank of America and Union Bank of Switzerland. Currently, he is the chairman of Centrum Group. So Centrum Group is a NBFC, and we can't get a better person to talk about NBFC than him. So yesterday, participants, while we had Mr. V.G. Kannan with us, he had years of experience in the Indian public sector bank. Today, we have Mr. Bindra with years of experience in multinational banks talking to us about NBFCs. I promise you, like yesterday, this is going to be a very, very interesting conversation. While I will be discussing with Mr. Bindra, you have the opportunity to ask questions in the Q&A box, as well as directly to him. Once again, Mr. Bindra, welcome to the show. Good to have you again.
Thank you, KK. Thanks for the introduction and the kind words. And also a big thank you to EPS for hosting this and being persistent and doing this every day of the week.
Thank you, sir. That encourages us to do more of this. Participants, I want to introduce to the subject. So permit me to ask some rapid queries to Mr. Bindra. So that will set the tone for today's discussion. Mr. Bindra, NBFCs are also called shadow banking. Why?
So if you look at the definition of shadow banking, it doesn't strictly include NBFCs, because shadow bankings are a group of financial intermediaries facilitating creation of credit, but whose members are not subject to any regulatory oversight. That is not entirely the case for NBFCs.
Okay, all right. So can you give me some examples of such institutions which come under the shadow banking? Are MFIs one of them?
No. So the kind of companies that come in are finance companies, asset-backed commercial paper conduits, structural investment vehicles, credit hedge funds, money market mutual funds, securities lenders, etc., who are completely in the non-regulated domain. And in fact, some people say BlackRock is the world's largest shadow bank.
Okay, that's right. So like banks, are they not regulated by RBI or some other institution?
So they don't have a direct supervisory regulation. And for the reason, that's why NBFCs sometimes loosely get called shadow banks as well. And the media has sort of made that coinage even more popular. But the reality is that NBFCs are not completely free from regulation. They just have fewer regulatory controls than banks have. So in some ways, they are more a hybrid. More a hybrid, yes.
Okay. So how important are they in the role of in our economy?
Well, they are very critical because they are very much part of the fundamental financial system. They are a large source of credit. They are a large medium and conduit of credit. In fact, the concept of credit growth by unregulated institution dates back to at least 1935 from what we know. And the term shadow banking itself was coined by a gentleman called Paul McCulley. He was with PIMCO. In 2007, he coined this word. It became very popular, particularly in relevance to China.
So, Mr. Bindra, though we have commercial banks, we have cooperative banks, we have RRBs, PACs, and so many of them. So, how did NBFCs evolve? Can you give us a background on how they came into being? Also, perhaps their highs and lows of the journey thus far with us in the Indian economy.
Yeah, so like we said, they've been around globally for a long period of time. And the more, if we look at it more closely from an India lens, clearly NBFCs came into being in the late 90s. That was when the large number of NBFCs came into being. There is, just for information, I mean, many people would know this, but there are about 10,000 NBFCs that are registered with RBI, of which only about less than 100, about 80 odd, are deposit-taking NBFCs, and about 250 out of the 10,000 are ones that are systemically important. And the benchmark for systemically important is to have an asset size of 500 crores and more. So I think that is kind of the size of the market, as we might put it. They are extremely relevant because in the last decade or so, they've become a big force in lending. Although when the NBFCs really got going in India in the late 90s, they were mostly in fee businesses, advisory businesses, more merchant banks and broking houses, loan syndication homes, etc. But then clearly the opportunity for lending came about, and they are now in the last year, I would be able to tell you that the data predicts that 1/3, this is pre-ILFS, the year before pre-ILFS, they were 1/3 of the actual credit lending was done by the NBFC. So they are a big force in the delta.
Okay, great. So we'll talk more about NBFCs. We know that they are under a lot of turmoil, and they're trying to emerge out of it stronger. So about this pandemic, Mr. Bindra, and the low offtake on credit, two things that are plaguing the entire financial industry in India, or maybe even the globe. So are NBFCs also facing this tough times? Is this double whammy of pandemic and the low offtake?
Oh, absolutely. The NBFC sector in India has got hit. Actually, I've said this before. They got hit very significantly with the ILFS failure, and since then, they were just about sort of seeing some green shoot recovery when the COVID has come and hit us again as a sector. And clearly the combination of COVID and the reduced credit flow from the banking system is definitely going to take the sector much longer to recover than it was earlier foreseen.
Okay, so I think even yesterday we heard how the banks are struggling. So I guess that holds for the NBFCs also. So Mr. Bindra, what is the future of NBFC as a sector and its role in building the economy when we already have many of these lending institutions?
So I feel that, like we said, the NBFCs do play a very critical part in the financial system of the country. And in many ways, lending by NBFCs forms the backbone of India's economy, especially because it does MSME. And they are the key financiers for MSMEs. There are about anywhere between 55 to 60 million MSMEs in India. which contribute to about 30% of India's GDP. And the credit demand in aggregate from these MSMEs is about 50 lakh crores. 40% of this is done by informal credit. So they don't even have access to formal credit. And so there is a very big opportunity to capture this unserved population and thereby partner India's growth opportunity. Banks find this segment either too expensive or unviable. And NBFCs with advanced technologies have been able to be far more effective in doing business with the MSMEs.
Okay, thank you. So you did mention about MSME, and there are as many as 60 million, and they contribute 30% of the GDP, which is a substantial portion of the GDP that MSME contributes. But as you know, MSME is also going through tough times, and there is a scheme that has been announced where you could lend to MSMEs without collaterals. So is that something NBFCs are also looking at, that pie of the business?
Oh yes, MSMEs are very much the mainstay of NBFCs in the retail side, and clearly the government guarantee scheme, the details are still very scant and early, but once that scheme comes into play, if it is in the way it is intended, then it could be a big boost to help the MSME sector in its recovery process.
Okay, thanks. Yesterday we had some of the participants' questions could not be answered because we really ran short of time, and I'm expecting this session also going to be doing that. So participants, please put in your Q&A as soon as possible so that I can take it across to Mr. Bindra, the maximum that we want to know from him directly. One of the big problems that NBFCs had is and many of say what are the main is about the collapse of INFS, if I say, and maybe there were a couple of others that also failed. And these were ILFS, at least I know, was to be called as it's a cannot fail institution, right? So big it was. So what were the main reasons for the collapse of ILFS and others?
So too big to fail is the common term that got coined in 2008 global financial crisis. And it was very liberally applied to big institutions like ILFS, particularly with the kind of parentage they have. They had LIC, they had SBI, HDFC, two foreign large groups from Japan, etc. But I think before we can, the easiest way for me to explain why ILFS failed is to explain very briefly how infrastructure financing works, because really ILFS was the best and the biggest player in the business of infrastructure. And infrastructure projects are capital intensive, and the returns are zero till the project is up and running. So not only is it big money involved in every project, but it is also not worth much during the construction period. Infrastructure products are also very long gestation and high risk during that construction period. It takes years to lay a major road or build a port terminal or roll out a telecom network or build a mining operation, etc., setting up a power plant, all of that. And all of these involve political hurdles because there is land acquisition, there is regulatory clearance required. So there are those challenges. The other issue with infrastructure projects is that the assets of unfinished projects are often worthless. So you recover nothing by seizing. And there are also several legal complications in seizing assets anyway. So a half-built bridge or a stalled power plant is actually worth nothing. And of course, apart from all of this, you have the usual endemic contractual disputes in infrastructure products. So the real reason ILFS failed was it went failed or went bust, whatever, because it lent to too many projects that went sour one way or another. And they were left with no money to repay their debts, which became due. And finally, on that fateful day in September, they first defaulted as the parent company on 1,000 crores due to SIDBI, and then another 500 crores through a subsidiary also to SIDBI. And of course, in those few days, their rating fell from AAA to D, and that sort of was a major landmark in terms of their history.
So Mr. Bindra, what are the lessons learned? Because we can't afford such collapses, such big institutions collapsing. So, like, what could be some of the lessons learned out of this?
So I think there are lessons learned not just for the NBFC sector. I think there are lessons learned for the regulators. There are lessons learned for the government. Yeah. I think the systemic risk that came out of ILFS was well beyond the 30,000-40,000 crores that was the hole or the plug that was required for ILFS. In fact, it has taken the entire NBFC sector, which is worth a lot more, down for at least a year plus after that. It has reduced the returns of the banks and mutual funds. It has increased the NPAs because there was a contagion effect, etc., or at least there was a fear of a contagion effect. So I think the lessons are learned broadly at the macro level, but clearly from a pure NBFC point of view, I think it comes back to the same thing. It's about ALM. It's about good risk underwriting. It's about having good business processes. And it is about ensuring liquidity at all times. So I think it's some combination thereof.
Okay, yeah. So you did mention perhaps one of the reason is the ALM part of it. So, Mr. Bindra, besides ILFS and others, there are NBFCs even today who are running large mismatch of the assets and liabilities books. Okay, how dangerous are these institutions, say to a common man and to some of the institutions they are lending?
So basically, KK, the NBFC business model is in some way flawed because they will always have an ALM mismatch in tenor. There is nobody who is going to lend to NBFCs in terms longer than they themselves can raise. So the banks typically raise 1 to 3 to 4 year, 5 year money at most. But the bulk of that deposit raising is in the 1 to 3 years. We don't have a good secondary bond market for tenor debt. We don't have pension funds which are actively playing the debt market. So clearly there is no other source of long-term debt. Whereas by nature, some of the assets that get financed by NBFCs, whether it is automobiles, whether it's real estate, infrastructure, these are long gestation loans. They are typically 5 to 10 year, 12-year loans. So that is a challenge. And when there is sufficient credit in the system and the cycle of refinancing is a matter of course, which it was for several years, there is no problem with that. But once that cycle of refinancing gets broken, and actually the ILFS default made that happen, then of course there are fears about a contagion. And then that's what has happened. And so now not only is there a credit choke, there's also been cost escalation on the existing or new funding that NBFCs can get. So I think there is all of this combination that is hurting the NBFCs. And actually what did happen also to give even more sort of difficulty with the ALM was that post the demonetization, there was excess money in the system because a lot of money came to bank deposits, a lot of mutual funds, and got money over from fixed deposit outflow. And the NBFCs accessed this cheap and plentiful funds and grew their loan portfolios at double the pace of banks post demon. And obviously, when you have too much money and a big rush to disperse that money, the underwriting standards come at a discount. And that is what happened, because everybody was, not only were the NBFCs, but also the banks and the mutual funds were chasing very high returns. And I think that further sort of created larger gaps in the LM ratios of companies.
Okay. Yeah, thanks, Mr. Bindra. That was a good explanation on the, because there is such a massive institution going under was really a shock to the, at least to the financial world in India. So when you have these problems with NBFCs, one of the common thing that anybody would say is that why are these institutions not being regulated? I mean, why can't an institution like RBI or NABARD come into the picture and regulate them so that they don't go out, they don't have a problem?
So I think it's let's say it's a gradual process. So first of all, we should know that all NBFCs have to register with RBI. You cannot get a license unless you are registered with RBI.
Okay.
The RBI does have existing supervision over NBFCs, far more specifically for deposit acceptance rules. So the NBFCs that are deposit accepting institutions have applications of how much they can accept in what tenors. So they cannot accept less than 12 months, not more than 60 months. They are not entitled to any payment or settlements. They cannot issue checks of their own. So things like that are already regulated. RBI has recently introduced a loan coverage ratio, which is really for NBFCs which are of certain size and above. It is for asset size of 10,000 crore and above if you're not a deposit accepting NBFC, and it has to be 5,000 crore and above asset size if you are a deposit accepting NBFC. They have now mandated that every systemically important NBFC, and there are roughly 250 of those, need to have a chief risk officer. They have also said that the net own fund, which used to be a measly 20 lakhs at the start, got raised in 99 to 2 crores. And they have authority to take that up to 100 crores. And my own guess is that it will keep going in that direction in a phased manner. In fact, they cancelled about 1,700 licenses in the last 12 months of NBFCs. RBI has cancelled, which either failed to meet the NOF or their capital adequacy. And there is also